24/7. Today's topic is very important because the session will start with credit conversion factor, meaning of that. Then we'll study CRAR, case study on CRAR, and then we'll study the objective questions. So CCF is a new point, very important point, which is always useful in calculations of various loans, means which are unutilized. Okay. So before going there, I would suggest download Adda 24/7 app on your mobile. Also join our Officers Adda YouTube channel. You will get all the updates regarding the latest exams, plus study material, plus live classes, tests, everything at one go only. So don't go here and there. Okay. So also important part, we are starting with this new selection batch. I'll come to this later in the later part of this lecture. We are starting with this new selection batch on June 6th. Be ready for that. Okay. What all are the details? You can watch this. I'll come to this later also. Okay. So let's start with the topic without wasting the time. So first part of today's session was meaning of credit conversion factor. Okay. So what is credit conversion factor? Remember one important part. All these definitions will be there, but I'll tell you in simple language. Okay. I always have a habit of telling in simple language. Something which is not taken, that is known as contingent liability. When that contingent liability will come on me means what? When I'll have to pay for that, at that time, what that conversion factor will be, that is known as CCF. Means right now I've given you a guarantee. That guarantee has not come to me for payment. But if it comes, then the percentage which I have, the capital which I have to keep for that part using the probability calculations. So that part is known as CCF. Now understood? Whatever is unutilized, only for that CCF is used. Whatever is utilized, CCF is full 100%. Okay? Keep this in mind. Now let's study the topic. Credit conversion factor is a coefficient in the field of credit rating. It is a ratio between the additional amount of loan used in future and amount that could be claimed. Okay, loan used in future and amount that can be claimed means if I am giving some additional loan to you, or if I am giving some contingent liability to you, this CCF means this CCF means whatever I am giving you, what will be the liability on me if it comes on me. Okay, it's that simple. So loan in future versus amount to be claimed, that's it. Okay, the key variables for the credit risk assessment are, now these three key variables are very important from exam point of view only. Okay, I'll tell you regarding the marks. CCF question will be there for almost 3 to 4 marks, at least 3 to 4 marks. Okay, then the case study which I will be taking will be there for at least 5 marks, 2 case studies, remember, so 10 marks. Okay, and last would be the objective questions. Those are also roughly 2 to 3 marks. So today's session will cover roughly 12 to 13 marks of yours in BFM. Okay, that's very important. So CCF is a coefficient, got this point. What is CCF? Loan used in future versus the amount to be claimed. So what percentage do I have to keep aside? Okay, the key variables of the credit risk assessment are probability of default, PD we call it, the loss given default, LGD, and exposure at default, EAD. These 3 points are very important for you. PD, probability of default, this is very important for CCF. Probability of default means what? Whenever if that guarantee comes to me for payment, what is the chance that guarantee will come to me for payment? Okay, so when does a guarantee come for payment for towards the bank? When the performer doesn't perform, isn't it? If I give you a guarantee, you are a contractor, and that guarantee is given on your behalf by me to some municipality. When will that municipality come to me for payment? When you don't perform, isn't it? So that is basically default. Okay, the loss given default, what will be the loss for me if you default? On the basis of whom, on whose performance the guarantee is given. So that is known as LGD, loss given default. And exposure at default means what is my total exposure. Remember, loss and exposure are different parts altogether. Loss is the final loss which it will be there. And EAD means what is the exposure I have to keep. Means what? Suppose if I give you the guarantee of rupees 100, so the exposure at default will be less than the rupees 100. Why? Because there are very few chances that the guarantee will come to me for payment. Because if you are a non-performer, only then that guarantee will come to me for payment. Got this point? So three keywords over here are PD, LGD and EAD. Remember, the full forms of these are asked in the exam. Okay, and also the point which is asked is the key variables in credit risk assessment are PD, LGD and EAD. The credit conversion factor calculates the amount of free credit line and other off balance sheet items transactions to an EAD amount, means exposure at default amount, means whatever are my off balance sheet items. So what are my off balance sheet items? What are my balance sheet items? Firstly, balance sheet items means, understand this very clearly, pay keen attention. Balance sheet items means those items where direct funds are given, means cash credit, term loan, these are all funded activities. Okay, so here directly funds are given to the customer, but off balance sheet means what? Where the funds are not given directly, means for example guarantee. In guarantee I don't give you the funds, but I give an assurance. LC, I don't give the funds immediately, but I give an assurance. If you present me the document, then I'll pay. So these are all off balance sheet items, right? We call it contingent. Okay, with exception of derivative. Derivatives are not taken in this. Okay, so all these off balance sheet items are brought to EAD level. EAD means what will be my exposure for these off balance sheet items if they come to me for payment. So for that I have to give certain proportion, not full amount, not LGD. I'll give some proportion because the probability of them coming to me is always less, isn't it? If an off balance sheet in an off balance sheet product, the bank is obligated to provide the money to the debtor once the need arises, right? Means if you come to me for payment, if the municipality comes to me for payment for that guarantee, only then I'll have to pay. Otherwise what? Otherwise no payment. To calculate the amount of money lost in the case of default, it is common practice to weight the amount of future obligations with those which could be in principle be drawn. So what does this sentence mean? This means what I told you just now. What is the probability that the municipality or that third party will come to me for payment? So that is known as this EAD, exposure at default. Okay, this sentence means the same thing. Now what are the drawbacks of CCF? The possible drawback of CCF is that it is a backward looking over a period of 12 months, which might not be appropriate for evaluating EAD at a given time. Means this CCF always checks the last 12 months period. Means it's checked for the previous 12 months. Now the situation presently can be different than what had happened in last 12 months. So this is a possible drawback. But then also, even with this drawback, CCF is used majorly in the banks, because what happens? It rarely happens that the present situation is different from something which has happened earlier. Okay, so this was the second schedule. This was in the schedule, means first schedule was regarding CCF. Now we can move to the case study. So okay, this case study, before going to the case study, I'll again tell you we are starting with the selection batch on June 6th. We'll be covering 35 plus hours of ABM, BFM, mock test and ebooks, last minute preparation, recorded videos 24/7, solve unlimited doubts. Okay, so I'll show you how to use the code later. Okay, so definitely join that. Now we'll come to the case study. Computation of CRAR means this problem CRAR, this case study arrives in each and every exam of BFM. Each and every. There is no exam of CAIIB, BFM where there is no case study of CRAR, at least 2 case studies. Okay, so get the concepts very clear. In a bank, tier 1 capital equals to 1000, tier 2 is given as 1200 crores, risk weighted for assets for credit risk is 10,000 crores, capital charge for market risk 500 crores, capital charge for ops risk is 300 crores. Find tier 1 capital, CRAR and total CRAR. Firstly, understand the meanings of these. Okay, what is tier 1 and tier 2 capital? Remember, capital is always consists of tier 1 and tier 2. It also consists of tier 3, but that is not taken into account. Why? Because tier 3 is an emergency capital. Understand this, emergency capital that arises due to market risk only. Understand this, tier 3 is only applicable to market risk. It is not applicable to ops and credit risk. Okay, why market risk? Because market risk is not in your hands. Credit and ops risks are in your hands. They can be controlled by you. Okay, so that's why capital consists of tier 1 and tier 2 only. What is tier 1? Tier 1 is the free capital. Free capital means what? Net worth. Net worth means what? My equity capital, total number of shares into price of that share, number one. The face value of that share, basically, number one. Number two, my net profit. Number three, reserves and surplus, right? So that is my free capital. Okay. Then borrowing. T2 is a borrowed capital. Borrowed means I take loan from you and then use it for my business. So that is a borrowed capital. Keep it simple. Okay. So remember one always basic rule. T2 cannot be greater than T1. Borrowed capital cannot be greater than free capital. Okay. So that's why T2 cannot be greater than T1. Now what have we to find? We have to find tier 1 and tier total CRAR. What is the formula for CRAR? CRAR equals to capital upon RWA. What is capital consists of? T1 plus T2. What does RWA consist of? 3. Credit, market and ops RWA. All the 3 RWA we have to find. So out of that, RWA for credit risk is already given, 10,000 crore. For market and ops we have to find, right? So 2 we have to find. Got this point? Now, what is CRAR prescribed by RBI? RBI prescribes CRAR minimum of 9%. Basel prescribes it for 8%. Okay, so remember these two numbers very well. Basel is 8 and RBI is 9. We also have bifurcations for this 9. Okay, we'll take that in some separate lecture, and also join the live classes. There I'll take it there separately. Okay, so let's solve the case study. Firstly, we'll find all the RWAs. Here, what is our target? Target is this: credit, market, ops, all RWA. Then T1 and T2 capital, right? T1 and T2 we already know, right? 1000 and 1200 over here, so we'll take 1000 only, because T2 can't be greater than T1. Okay, so first find RWA. Credit risk for RWA for credit risk already given, 10,000 crores. Now find RWA for market risk. What is the formula for RWA for market risk? Here, same formula. CRAR equals to capital upon RWA. Okay, we want capital over here. We want RWA over here. Okay, so RWA equals to capital upon CRAR. So capital is already given in the case here. Capital charge is 500 crores. So capital charge means capital only. Take that only. Okay, so 500 upon CRAR. CRAR is 9% prescribed by RBI. Take this figure directly. Okay, so 500 upon 0.09, we get 555,556. Okay, firstly, how many of you are solving this case study now? Type yes if you are solving it. Take pen and paper and calculating in your hands. First take this. Okay, solve that case study fastly. You solve it yourself. Okay, give me the answers now, because these are simple calculations. Everyone must do it. In exam nobody will be there to help you. Okay, so RWA for market risk, what? 500 upon 0.09. Find the answer whether you are getting 5556. Type yes if you have got 5556. Type yes fast. What is the answer? You have got 5556. Okay, now RWA for ops risk. What is it? Again same formula, capital upon CRAR. Capital is what? 300 given in the question itself. See this, 300 crores. Okay, so this 300 crore upon 0.09. What is the answer? What is the answer you are getting? Are you getting 4 times 3? 3. Are you getting the same? Yes please. Fast. Everyone must answer. Yes, type yes if you have got the same answer. Type yes, everyone. Type yes. Yes, now you are typing. So now add them. 10,000 total RWA we wanted. What was the target? See this, total RWA, credit, market, ops, total. So now we have got all the 3. So add them. 10,000 plus 5556 plus 4 times 3. What is the answer you are getting? 1,889 means 18,889 crores. This is the RWA, total RWA. Okay, Now what is the next target capital? T1 and T2. So T1 is given as what? 1000 crores. T2 is given as 1200, but we can take maximum up to 1000 only. Why? Because T2 cannot be greater than, yes, T1. Type yes. T2 cannot be greater than T1. Everyone type this. T2 should be equal to T1 maximum. Okay. Everyone must know this. T2 cannot be greater than T1. Okay. So now what is the final capital? Capital to me 1000 plus 1000. Tier 1000, tier 2000. So 2000 is my total capital. Now what? My next target is tier 1 CRAR and total CRAR. So tier 1 CRAR means what? Eligible tier 1 upon total RW. What is tier 1? Tier 1 is 1000. Just now we saw it, it's given over here. 1000 upon 1,889, 18,889 into 100, of course. So divide this. What is the answer you are getting? 1000 upon 18,889 into 100. What is the answer you are getting? Fast, 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 fast. Yes. What is the answer you are getting? Correct. 5.29. Everyone is getting the same answer, 5.29. So remember, this is 5.29, and what is given by RBI? It should be 7%. So we are the bank is at a lower edge, okay, from the required CRAR, tier 1 CRAR. Total CRAR. Total means total capital upon total RW. What is the total capital? 2000 crores, right? Just now we saw it over here, 1000 plus 1000. So 2000 upon 18889. Okay, so it is 10.59. Type yourself, do the answer. Whether are you getting this 10.59? Everyone must type this. Are you getting this 10.59? Fast, fast, fast. 10.59. Is everyone getting this? Type yes if you have got it. Type yes. Yes, fast, fast, fast. Yes. Yes, now you have got it. So 10, everyone here, it's for you to practice, not for me or none of the teachers in the world. It's after all you have to practice because you have to give the exams. Okay. So 10.59 is the CRAR, total CRAR. So is it good or bad? What does RBI prescribe? 9%. This is greater than that. So total CRAR is good, but tier 1 CRAR is bad, right? So what should that bank do? Raise more equity capital, because it has a more chance for raising tier 1 equity capital. Okay. So in fact, it's a good sign for that bank, frankly for that bank as such, because it has a more scope of raising up to 1.5 or 7 minus 1, 1.29. That much it can raise more. Okay. So again I'll come to this class. See this 35 plus hours of mock ABM and BFM. Here ABM and BFM you get roughly 12 case studies of 5 marks each, okay, in each subject. So we'll be conducting all the case studies over there. All the mock tests would be there. You'll have the notes for that. You'll have the recorded videos for them. So definitely go for it. Okay. How to use the code at the end I'll show you. Now we'll come to the objective questions. What is the financial risk that refers to the uncertainty over future interest rates and the impact on the company's future cash flows and the fair value of the financial instruments? Means over the uncertainty over the interest rates, means the uncertainty over the interest rate means interest rates may go up or down. So what will be that known as? Price, credit, interest rate and foreign currency. Simple answer. Everyone answer the same. Fast, fast, fast. Simple answer. What is the answer for this? You're already getting the name in the question itself, isn't it? So interest rate. The answer is C. You'll type this A, B, C, D. Okay. So answer is C. Interest rate risk. Okay. I'll write the answer over here. One sec. This is the answer. Interest rate risk. Right. Next. What is the financial risk pertaining to the possibility of contract being dishonored? Contract is dishonored. Contract dishonored means what are the three types of risks? Credit, ops and market for banking, Basel. Okay. So out of these three only we have to select. Price, credit, interest rate and foreign currency. So contract being dishonored. Contract means what? If I make a contract with somebody and that guy doesn't pay. Like the loan. Loan is a contract between the bank and the customer. Customer doesn't pay, so contract is dishonored. So that is the type of which risk? A, B, C or D. Type fast. A, B, C or D. Fast, 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 fast. Yes. Yes, yes, yes. Yes. Correct. The answer is credit risk. Because these risks are totally different, isn't it? Tier 1 capital does not include. What does tier 1 include? What did I tell you? Net worth, equity, net profit and R&S. So here assets, common stock, preferred stock and retained earnings. So common stock means common equity, which I told you. Assets means all the assets, that is also a part of tier 1 capital. Means these are free assets actually, okay? And retained earnings, yes, that's a part of reserves and surplus. But preferred stock is not a part of tier 1 capital. Why? Tell me why preferred stock is not a part of tier 1. Because preferred stock is a compulsory paid capital. Means in preferred stock, preferred shares, I'll have to pay the dividend at any cost. So that's why it can't be a part of tier 1. Except it is PNCP. For PNCP, perpetual, non-cumulative, preference shares, this is a part of tier 1. Okay, because the name is perpetual, non-cumulative. Non-cumulative means dividends are not compulsorily to be paid. Okay, so in that case only it becomes a part of T1, but general preferred stock not a part of T1. Tier 1 capital is also known as what? Preferred, core, common cash and preferred assets. ABCD. Type fast. Preferred, core, common cash and preferred assets. Tier 1 is the which type of capital? Type fast. Common cash? No. Preferred asset? What is this preferred asset? There is nothing called as preferred asset. Common cash means cash equivalent. So capital and cash are totally different. Cash is a part of that capital. Okay? Cash is a part of that capital, but it's not a capital. So answer is correct. Everyone is typing correct. B. Right? Core capital. This is the core capital, and tier 2 is a supplementary capital or paid capital. Okay? This is known as a higher capital, that is known as a lower capital. What is tier 2 capital? Commonly known as core, supplementary. Just now I answered it. Supplementary, primary and none of the above. So answer is correct. Just now I answered it, isn't it? Core means tier 1, supplementary means tier 2. So answer is supplementary. Okay, tier 2 capital has many names. Even tier 1 has also many names. Core capital, headline capital, that is bottom line capital. Supplementary tier 2 core capital, then it is known as primary capital, secondary capital, free capital, paid capital. Means I'm giving the bifurcation, so you can have any names. Okay, logic is simple. Tier 1 is free capital, tier 2 is paid capital. That's it. Okay, the primary difference between tier 1 and tier 2 capital is tier 2 is tier 2 is a capital seen riskier than tier 1. T1 is a cash on hand, while T2 is stocks and bonds. T1 is seen riskier than T2. There is no difference. So D is definitely out. Either ABC. Okay. So which one of these? Is T1 more riskier than T2? Which is the free capital? Tier 1 is the free capital, right? If tier 1 is the free capital, then how can it be riskier? So this is out. Now only A and B. Which of this? T2 is cash on hand. So tier 1 and cash on hand. Cash on hand will be a part of tier 1, but tier 1 is not cash in hand. Okay, so that is also out. So answer remains only 1. T2 is seen as a riskier than tier 1 because T2 is a paid capital, isn't it? And T1 is not a paid capital, it's a free capital, isn't it? Which of the following is not a part of tier 2 capital? Subordinate debt, undisclosed reserve, revaluation reserves and stock. Not a part of T2, huh? Not a part. Not. So stock is a part of what? What did I tell you in T1 capital? T1 what was the part? Stocks means shares. In US or common English we call it stocks. In India we call it shares also. Share value you can call it. That, net profit and R&S, reserves and surplus, right? R&S. Okay, so stock becomes a part of T1. So if it is a part of T1, how can it be a part of T2? So that is out. That is not a part of T2. Okay. What do you call the designation of one or more financial instruments so that the change in the fair value or cash flows of the derivative will offset in whole or in part the change in the fair value of the cash flows of the hedged items? So whatever we have hedged, that hedged items will be offsetted, or that hedging will offset the change in the position of that stock or whatever that commodity is. So that is what hedging, borrowing, foreign exchange transaction, and budgeting. What is the answer? Means the change in fair value or cash flows of the hedged items, means already it is hedged. Okay, already it is hedged, and it is offsetting, means one or more financial instruments, so that change in their fair value. What do you call the designation of one or more financial instruments? Which are those financial instruments? Okay, which the change in the fair value of the or cash flows of the derivatives will offset the change in value of the hedged item. So basically what I am saying is, what the question is the items are already hedged. So what are those instruments called as? These are known as foreign exchange transactions, right? What are these foreign exchange transactions? For hedging, so that they offset the thing, that is known as swaps, generally swaps. Okay, swaps, these are the best instruments used for offsetting the cash flows. Okay, so coming back to this to the lecture part or the live class which is coming up, remember, many of you have asked me for this code Y432. What's the use of this code? Here it's a discount code. So this discount code, I'll tell you how to use it. Go to Adda 24/7. I'll show you over there. One sec. Go to Adda 24/7. Yeah. See here. This is the website of Adda 24/7. Go there. On going there, see here the changes in the website. Click on all courses. When you go to the home page, you won't see all this. On the home page it's different. Okay, go there, see this, enter. So you have come to the home page now. On the home page itself, you can go down also. Here also you will see many things. Also for the simplest part, go directly over here where all courses, or even JAIIB CAIIB, that is also okay. Click on JAIIB CAIIB. In JAIIB CAIIB you see this, click on CAIIB. On CAIIB you see this now, all the batches. See this, click on this selection batch with my photo. Okay, the selection batch, my photo, once you click on it, you will see all the details which I have just now told you. All that 35 plus hours of ABM BFM, you can read this again. Okay, it's very useful. Remember, the recorded videos are very useful for those who are in banks, because what happens, we don't get time many times. Okay, so that will be useful for you. You can go at the ease of your hours, ease of your time. Okay, so view offers, click on view offers. Once you click on view offers, see this, you will get all this coupon code. Click on this coupon code Y432. Click on this code, put apply. See now the fees from 13,299 it has reduced to 3,058. If you see this 3,058 and compare with your CAIIB increment, 1,300 is your rough increment, right? If you are at a clerical level, 2 increments. If you are at a officer level, single increment, roughly the same amount, 1,200 to 1,300. Okay, so this will get recorded in how many months? 3 months, remaining everything throughout for you throughout the life. Okay, so go for it as fast as possible. Tomorrow again I'll see you with another topic, and see you in the live classes on June 6th.